Admit it, there was a time last week where we didn't think we'd even have two strong days in a row. Well, we did, right? I mean, last week was volatile, it was rough. But the big question now, is the worst over? Here to discuss, Kevin Kelly, managing partner at Benchmark Investment. Doug Flynn, co-founder of Flynn Zito Capital Management, and back with us, Gary Kaufbaum. Let me start with you, Doug. It would seem premature to think that it's over, particularly considering how violent those swings were. But should we be breathing a sigh of relief?
I think it's a sigh of relief, but the typical downturn, if you look since 1980, there have been 36, 10% or more downturns. And the average is about 16%. So it's possible. It's a little too early to say it's definitely over, but it's a good sign, and I think that presents an opportunity. And so I wouldn't expect maybe that there wouldn't be more of an opportunity again, but these are the times when you want to add when the market's off a bit.
Right, but here's the thing, Kevin. It felt like there was a reason du jour almost every day, right? Initially, hey, Mnuchin shouldn't have talked down the dollar. The yields are getting high. VIX is spooking people. These weird products have, I mean, almost every day there was a reason du jour. So do we know why the volatility came out of nowhere, and subsequently, if we did know why, would that help us understand when it's over?
I think there's a lot of policy decisions that actually have changed the fundamental underpinnings of the market, and one of them is the tax policy, right? So I think a lot of analysts and investors are trying to digest who is this good for. There will be winners and losers in certain industries, but overall the market will go up. So they're trying to figure out which industry should trade at certain multiples and which shouldn't. Now, the overall market came down to 16.5 multiple. We hadn't seen that since November of 2015. That was right before the Fed decided to get off this zero bound. And then if we go back to January of 2016, we saw a downturn, right? But then after we worked through that, we had an 11% a month, February into March. So it's reminiscent of that time frame. So once we get our sea legs, I think the market can go up from here.
But Gary Kaufbaum, how do we get our sea legs?
Time and price. Look, I don't think a market drops 11 to 12% in a matter of days and everything's A-OK. Now, I do think Friday, and we said it on the weekend, I think we got a low when you hit big long-term support and really bounced hard. You followed through today. I am not sure about the low. I think there's some time and price to go. There's a clear loss of leadership in the market. The strongest stocks, for a good reason, are the defense stocks like Lockheed Martin, Northrop, and Raytheon. But after that, I'm not finding a lot of leadership just yet. I think we need some more time backing and filling in here.
Doug, is there a sector that you think should or should lead the way? We know these big tech names for a while last year masked the fact that internally it wasn't necessarily a great market. It was, you had 5 or 6 names really dominated and really, for the most part, there were a whole bunch of stocks that just weren't really performing that well.
Yeah, real estate's way down. Energy is way down. So, I mean, what we like to do is it's easy to chase the things that continue to do well. And there's no reason why they can't continue to do well. But we like to pick around the edges of the things that are really beaten down, because you can't keep going up at 30% a year indefinitely. At some point, some of those areas that are out of favor are going to come back, whether it be energy. You have to be careful with utilities because it's interest rate sensitive and real estate. But those are some of the areas you want to start picking in a rebalancing portfolio. That's what you need to do. Look the areas where they're down the most, and look for those individual pieces, not the entire sector per se.
Well, there's some individual names that you like.
Yeah, I like the tech sector, especially because they're going to thrive in this environment due to the fact that their cost of capital is lower. They actually have net cash on their balance sheet. So if you look at this past earnings season, NVIDIA beat and crushed, and they're actually growing in the chip segments, especially on their GPUs, which is the graphics processor units. And everyone's using it for AI. They're using it for autonomous driving. They're using it to mine crypto. They're using it for gaming. Also, look at Microsoft. Microsoft grew their Azure cloud 95%. Last quarter, it was 85%.
Are you concerned, though, Microsoft's cloud business is not the same as Amazon's cloud business, right? So it's a different kind of cloud business and not necessarily as profitable.
It is, but I'm also not worried about it because companies are using their new income to funnel it into investments in their property, plant, and equipment. They have great productivity, especially when it comes to the cloud. But here's the important thing. They're not battling. They're not in this ferocious advertising battle where you have Facebook battling against Amazon, which is battling against every other company. They're not worried about that. So they're focused on the nuts and bolts of the internet. Which
when it comes to Amazon, they're Godzilla in every industry is Mothra, right? Guys, thank you all very much. Appreciate it. Well,